Introduction. The myth of the Wall Street genius. You turn on the financial news. You see a fast-talking analyst surrounded by a chaotic wall of blinking green and red numbers, making a series of bold, confident predictions about the future of the stock market. You hear stories of genius hedge fund managers who made $1 billion by timing the market perfectly. You look at this world of high-stakes trading, complex charts, and arcane financial jargon, and you think to yourself, this is not a game for me. You've been sold a powerful, intimidating myth that investing is a dangerous, high-stakes casino, a game that is rigged for the insiders and the Wall Street geniuses. You believe that to succeed, you need a degree in finance, a complex analytical mind, and a high tolerance for risk. So you do the one thing that guarantees you will lose. You do nothing. You leave your hard-earned money sitting in a low-interest savings account, where it is silently and relentlessly being eaten away by inflation. This is a catastrophic mistake. Successful, long-term investing is not about being a genius. It is not about timing the market. It is not about picking the next hot stock. In fact, the research is clear. The vast majority of those genius professional money managers fail to beat the market average over the long term. Great investing is not about being a brilliant trader. It is about being a disciplined architect. It is a systematic, often boring, and surprisingly simple process of building a diversified portfolio and letting the unstoppable power of compounding do the heavy lifting for you. Welcome to From Zero to Investor. This is not a book of risky trading strategies or get-rich-quick stock tips. This is a practical, step-by-step roadmap for the self-taught, everyday investor. We will treat your journey to financial freedom not as a gamble, but as an architectural project. First, we will demolish the myth of the Wall Street genius and install the powerful business owner mindset. We will deconstruct the unbreakable, mathematical laws of compounding that are the true engine of wealth. Next, we will give you the single, most effective, and scientifically proven strategy for the vast majority of investors. A simple, set-it-and-forget-it system built on low-cost index funds. For those who are interested, we will then provide a toolkit of the core principles used by legendary investors like Warren Buffett. Finally, we will give you the blueprint for putting it all together to build a true financial freedom machine. It's time to stop letting fear and complexity keep you on the sidelines. The system is learnable. The path is proven. The journey begins now. Part 1. The Foundation, the Architecture of a $1 Million Mindset. Case File 01. The Architect's Mindset. You are not a gambler. You are a business owner. Before you buy your first share of stock, we must perform the most critical and most profitable identity shift of your entire financial life. The number one reason that most individual investors fail, the reason they buy high, sell low, and consistently underperform the market, is that they are operating with the wrong identity. They are acting like a gambler. A gambler is a speculator. They are obsessed with the day-to-day, meaningless fluctuations of the stock market. They watch the blinking red and green numbers like a hawk. They are chasing hot tips and trying to predict the future. Their decisions are driven by the primal, destructive emotions of fear and greed. They are a player in a high-stakes casino, and the house always wins. You're not here to be a gambler. You're here to be a business owner. This is a profound and non-negotiable distinction. An architect of wealth understands a fundamental truth. A share of stock is not a lottery ticket. It is not a blinking number on a screen. A share of stock is a tiny, fractional ownership stake in a real, living, breathing business. When you buy a share of Apple, you're not betting on a ticker symbol. You're becoming a part owner of a massive, global enterprise. You now own a tiny fraction of their factories, their patents, their brand, and, most importantly, their future profits. This is a shift from a short-term, stock market mindset to a long-term, business mindset. The gambler asks, what will the stock market do tomorrow? This is an unknowable question. The business owner asks, is this a high-quality business that will likely be larger and more profitable 10 years from now? This is a knowable, architectural question. The gambler sees a 20% drop in the stock market and panics, thinking, I have to sell. The business owner sees a 20% drop and thinks, excellent. The great businesses I own are now on sale. This is a perfect opportunity to buy more at a discount. The goal is not to play the market. The goal is to own a diversified portfolio of the world's greatest businesses and to hold them for a very, very long time. You're not a trader. You're a long-term, patient, and disciplined business partner. Case File 02, The Unbreakable Law of Compounding. How to make time your greatest ally. There is a force in the universe that Albert Einstein reportedly called the eighth wonder of the world. It is a mathematical law that is so powerful that your deep, intuitive understanding of it is the single greatest prerequisite for building wealth. This is the law of compound interest. The amateur investor is looking for the quick win. They're trying to double their money overnight. They are ignoring the single most powerful variable in the entire wealth creation equation. The architect of wealth is not a sprinter. They are a marathon runner. They know that the secret to building $1 million portfolio is the slow, patient, and relentless accumulation of small, consistent gains, amplified over a long period of time by the unstoppable force of compounding. Compound interest is a simple concept. It is the process of your investment returns themselves earning returns. It is a snowball. As it rolls downhill, it not only gets bigger, but the rate at which it gets bigger also increases. Let's deconstruct this with an example. Imagine two investors. Investor A is the procrastinator. She is 35 years old and starts investing $500 every month for 30 years, until she retires at age 65. Investor B is the architect. He is 25 years old and also invests $500 every month, but only for 10 years. At age 35, he stops investing completely and never adds another penny. Who has more money at age 65? Assuming a conservative 8% annual return, Investor A, the procrastinator, invested a total of $180,000. Her portfolio will be worth approximately $740,000. Investor B, the architect, invested a total of only $60,000. But at age 65, his portfolio will be worth approximately $950,000. This is not a typo. The architect, who invested 1/3 of the total money, ended up with over $200,000 more. The difference was not the amount of money, it was the time. This reveals two unbreakable laws. First, the start yesterday mandate. The single most important day to start investing is yesterday. The second best day is today. Second, the never interrupt it mandate. Every time you pull your money out of the market, you're stopping the snowball and forcing it to start all over again. Case File 03, The Mr. Market Protocol. The simple, stoic mindset for surviving market crashes. You're now an investor. You're a disciplined, long-term business owner. You have an automated system consistently buying a diversified portfolio. And then it happens. The stock market crashes. The news is filled with panic and doom. Your portfolio is suddenly down 20 or 30%. This is the moment of maximum peril. It is the moment that separates the successful architect from the amateur gambler. The primitive, emotional part of your brain will start screaming. Every instinct will tell you to do something, to sell everything before it goes to zero. This is the single most destructive impulse an investor can have. The architect does not rely on willpower to survive these moments. They rely on a mental model. The most powerful mental model for surviving the emotional roller coaster of the market was created by the legendary investor Benjamin Graham. It is the parable of Mr. Market. Imagine that you are business partners with a very manic depressive man named Mr. Market. Every single day, Mr. Market comes to your office and offers to either buy your shares of the business or sell you his shares. On some days, Mr. Market is euphoric. He is wildly optimistic. On these days, he will offer to buy your shares from you at a ridiculously high price. On other days, Mr. Market is panicked and despondent. He is convinced the world is coming to an end. On these days, he will offer to sell you his shares at a ridiculously low, bargain basement price. Mr. Market has one other crucial characteristic. He does not mind being ignored. He will be back tomorrow with a new price. You are under zero obligation to trade with him. You, the rational business owner, have a choice. When Mr. Market is euphoric, you can choose to sell to him or simply ignore him. When Mr. Market is despondent, you can either ignore him or take advantage of his pessimism and buy more shares from him at a wonderful discount. The one thing you'll never do is sell your shares to Mr. Market simply because he is in a panic. A market crash is simply Mr. Market showing up at your door in a state of extreme, irrational panic. This simple mental model is your shield. It creates a psychological distance between you and the madness of the market's daily fluctuations. It transforms a moment of terrifying fear into a potential opportunity. Case File 04, The Investor's Toolbox, a minimalist guide to opening a brokerage account. You have a mindset. You understand the unbreakable laws of compounding and the stoic discipline required to survive the market's mood swings. You are now ready to take the first, tangible, and most important practical step in your entire journey as an investor. You must open a brokerage account. The amateur at this stage is often paralyzed by choice. The world of financial services is a confusing jungle. They spend months researching the perfect platform, a form of intellectual procrastination that delays the single most important action, starting. The architect knows that for a long-term, passive investor, the choice of a brokerage is actually a very simple one. You're looking for a company with a long track record, a reputation for integrity, and rock-bottom low fees. This is the big three low-cost brokerage blueprint. The world of low-cost, retail investing is dominated by three industry-leading titans. Opening an account with any one of these three is a safe, smart, and professional choice. 1. Vanguard. This is the gold standard. Vanguard is the company that invented the low-cost index fund. They're the original pioneers. Their unique structure means their primary legal obligation is to their own customers, which keeps their fees as low as humanly possible. 2. Fidelity. This is the juggernaut. Fidelity is a massive, highly respected company. They have become a leader in offering funds with a 0% expense ratio. 3. Charles Schwab. This is the best of both worlds. Schwab offers a fantastic combination of low-cost options, excellent technology, and great customer support. The process of opening an account is simple and can be done online in about 15 minutes. Step 1. Choose your firm. Do not spend more than 10 minutes on this decision. They are all excellent. Step 2. Choose your account type. You will be opening an individual brokerage account. We will discuss tax-advantaged accounts like a Roth IRA later. Step 3. Provide your information. You will need to provide your personal information, including your social security number and bank account information. Step 4. Fund the account. Make your first transfer of funds. It does not matter how small the amount is. The most important thing is to start. Congratulations. You have just completed the most important practical step of your financial life. You are officially an investor. Part 2. The Passive Investor Protocol, the 99% Solution. Case File 05, the Don't Find the Needle Mandate. Why you should buy the entire haystack. You have opened your brokerage account. Your money is sitting there, ready to be invested. Now, you face the single biggest and most intimidating question in all of investing. What should I buy? The amateur investor, a victim of the Wall Street myth, believes that their job is to be a brilliant stock picker. They believe they can, through diligent research or a hot tip, find the next Amazon or the next Apple, the one single magical needle in the vast haystack of the stock market that will make them rich. This is a fool's errand. It is a game that is almost impossible to win. The data is clear, overwhelming, and undisputed. The vast majority of professional, full-time, genius-level money managers fail to consistently beat the average of the market over the long term. If the professionals can't do it, the odds that a part-time individual investor can are practically zero. The architect of wealth does not play a game they cannot win. They do not try to find a needle. They make a simple, elegant, and profoundly powerful strategic decision. They buy the entire haystack. Instead of trying to pick the one or two winning companies, the passive investor makes a single, simple purchase. They buy a total market index fund. An index fund is a type of mutual fund or ETF that doesn't try to beat the market. Its one and only job is to be the market. It does this by automatically buying and holding a tiny piece of every single company in a major market index, like the S&P 500. This simple, boring strategy is a masterpiece of architectural design for three reasons. 1. Instant, massive diversification. With one single purchase, you have instantly become a part owner of thousands of the most powerful companies in the country. You have eliminated the single stock risk that can wipe out an amateur investor. 2. Rock bottom low costs. Because an index fund is not run by a genius stock picker, its operating costs are incredibly low. This means more of your money stays in your pocket, compounding for your future. 3. Guaranteed market returns. By definition, an index fund will give you the average return of the market. Over the long arc of history, the average return of the U.S. stock market has been a powerful engine of wealth creation. By simply buying the haystack, you are virtually guaranteed to outperform the vast majority of professional investors. Case File 06. Deconstructing the Index Fund, the one and only investment you'll ever need. You have embraced the by the haystack philosophy. You're ready to execute. You log into your new brokerage account and are faced with a new, final layer of jargon. You will see a list of different index funds with strange 4 or 5-letter ticker symbols like VTSAX, VTI, FZROX, and SWTSX. The amateur, at this final step, can get paralyzed by choice. The architect knows that while the names are different, these are all just different brand names for the exact same, simple, powerful product, a U.S. total stock market index fund. This is a simple guide to the specific flagship total haystack fund offered by each of the big three brokerages. For 99% of a U.S. investor's portfolio, one of these funds is the only investment they will ever need. Index funds come in two flavors: mutual funds and ETFs. A mutual fund is the classic version, bought and sold at the end of each day. An ETF, or exchange-traded fund, is the modern version that trades on the stock exchange throughout the day like a single stock. For a long-term, set-it-and-forget-it investor, the difference is almost completely irrelevant. Both are excellent. Here are the flagship funds of the big three. If your brokerage is Vanguard, the mutual fund is VTSAX. The ETF is VTI. If your brokerage is Fidelity, the mutual fund is FZROX. This is Fidelity's groundbreaking fund with a 0% expense ratio. The ETF is IQOT. If your brokerage is Charles Schwab, the mutual fund is SWTSX. The ETF is SCHB. Your mission for this chapter is to make your first investment. You will log in to your chosen brokerage. You will find the trade button. You will type in the ticker symbol of the flagship total stock market fund for your brokerage. You will enter the dollar amount you wish to invest, and you'll click buy. You have just executed one of the most powerful financial moves of your life. With a single transaction, you have become a part owner of the entire American economy. You have built your financial foundation on the bedrock of the most powerful wealth creation engine in human history. Case File 07. The three-fund portfolio blueprint. A simple, diversified, set-it-and-forget-it strategy. You have made your first, and most important, investment. You have purchased the U.S. total stock market haystack. For many investors, this single investment is a perfectly simple and powerful good enough portfolio for their entire life. However, the architect of wealth knows that there are two additional steps we can take to make our portfolio even more robust, resilient, and diversified. This is the three-fund portfolio, a simple, elegant, and legendary portfolio design championed by the founder of Vanguard, John Bogle. It is the masterpiece of passive investing, designed to give you a perfectly diversified, global portfolio with just three simple, ultra-low-cost index funds. Fund 1. The U.S. Total Stock Market Index Fund. This is the core of your portfolio, the primary engine of your growth. This will typically make up the largest portion of your stock allocation, often around 50 to 60% of your total portfolio. Fund 2. The International Total Stock Market Index Fund. This is your global diversification. The U.S. stock market only represents about 50% of the world's total stock market value. To be a truly diversified global business owner, you must also own a piece of the great companies in Europe, Japan, and emerging markets. This protects you from a scenario where the U.S. economy has a lost decade, while the rest of the world is booming. This will typically make up around 20 to 30% of your portfolio. Fund 3. The Total Bond Market Index Fund. This is your shock absorber. Stocks are the high-growth engine. Bonds are the brakes. Bonds are far less volatile than stocks. In a major stock market crash, bonds often go up or stay stable. Owning a small allocation of bonds dramatically reduces your portfolio's overall volatility and will help you sleep at night during a crash. A simple rule of thumb is to hold your age in bonds. A 30-year-old might have 10 to 30% of their portfolio in bonds. A sample 3-fund portfolio for a 30-year-old might be 60% U.S. stocks, 30% international stocks, and 10% bonds. This simple portfolio is the pinnacle of passive investing strategy. Case File 08, the Automation Engine, a system for building wealth on autopilot. You are now in possession of the perfect architectural blueprint for your financial freedom. You have the long-term business owner mindset. You have a low-cost brokerage account. You have a simple, powerful, and globally diversified 3-fund portfolio. Now, we must execute the final and most critical step. We must take this entire system and put it on complete autopilot. The amateur investor makes a fatal behavioral error. They rely on their own flawed human discipline to execute their investment plan. They tell themselves, I will remember to invest $500 every month. But life gets in the way. Their investing is inconsistent and driven by emotion. The architect knows that the single greatest enemy of a long-term investment plan is the flawed, emotional human brain of the investor. The architect's final move is to fire themselves from the day-to-day management of their portfolio. This is the autopilot blueprint. It is a simple, set it once and forget it protocol. Step 1. The automatic investment mandate. Every major brokerage has a feature called automatic investments. You will navigate to this feature. You will set up a recurring, automatic transfer of a specific amount of money from your bank account into your brokerage account on a specific schedule. You will schedule this transfer to happen on the day after you get paid. This is called paying yourself first. This strategy is also called dollar cost averaging. By investing the same amount every month, you automatically buy more shares when the market is down and fewer shares when the market is up. Step 2. The automatic allocation. As you set up your automatic investment, your brokerage will ask you how you want that money allocated. You will now tell the system to automatically split every single investment according to your predefined 3-fund portfolio allocation. Step 3. The forget about it protocol. This is the hardest step. Your machine is now built. It is running. Your final and most difficult job is to leave it alone. You will delete the brokerage app from your phone. You will not check your portfolio balance every day. You're a long-term business owner, not a day trader. This is the pinnacle of the passive investing philosophy. You have successfully eliminated the single biggest point of failure in the entire system. Part 3. The Active Investor Toolkit, Optional Advanced Section. Case File 09. The Warren Buffett Mandate. How to analyze a business, not a stock ticker. A word of warning. The passive investor protocol is the recommended, proven, and mathematically superior strategy for 99% of all investors. The section you're about to read is an optional, advanced deep dive. It is for the small handful of individuals who have the time, temperament, and obsessive passion for business analysis required to even attempt the game of active investing. If you do choose to venture down this path, there's only one sane, time-tested philosophy to follow. It is the philosophy of value investing, pioneered by Benjamin Graham and perfected by his student, Warren Buffett. The amateur stock picker is a speculator. They look at squiggly lines on a chart. The value investor is a business analyst. They follow one simple mandate. We are not buying a stock. We are buying a business. A value investor would never buy a stock without being able to clearly answer these 4 fundamental questions about the underlying business. Question 1. Can I understand it? This is the circle of competence. You must have a deep, practical understanding of how the business actually makes money. Can you explain what this company does to a 10-year-old? If not, you must not invest. Question 2. Does it have a durable competitive advantage? This is the moat. A great business has a moat that protects it from competitors. This could be a powerful brand, a network effect like Facebook, high switching costs, or being a low-cost producer like Walmart. Question 3. Is it run by honest and able management? When you buy a business, you are hiring its CEO. You must trust them. Read the CEO's annual letter to shareholders. Is the CEO honest and transparent about mistakes? Do they have a clear, long-term vision? Question 4. Is it available at a fair price? Even a wonderful business can be a terrible investment if you pay too much for it. You must be able to calculate a rough estimate of the business's intrinsic value and then have the discipline to only buy it when it is offered at a significant discount. This is the margin of safety. Case File 10. Reading a financial statement. A simple guide to the balance sheet and income statement. You are now a business analyst. You cannot analyze a business without being able to read its financial reports. For a publicly traded company, there are 3 primary financial statements: the income statement, the balance sheet, and the cash flow statement. The amateur investor is intimidated by these documents. The architect of wealth knows that you do not need to be a CPA to understand the story these documents are telling. This is the business health check blueprint. First is the income statement. This is the report card. It is the business's report card for a specific period, like a year. It tells you how much money the business brought in and how much it spent. The story it tells is, did we make a profit? There are 3 key lines to look at, and you're looking for a consistent, upward trend over the last 5 to 10 years. Line 1 is revenue or sales. This is the top line. Is it growing? Line 2 is net income or earnings. This is the bottom line, the company's profit. Is it consistently profitable? Line 3 is earnings per share or EPS. This is the net income divided by the number of shares. Second is the balance sheet. This is the snapshot. It is a snapshot of the business's financial health on a single day. The story it tells is this business financially strong? The unbreakable equation is assets equals liabilities plus shareholders' equity. There are 3 key lines to look at. Assets are what the company owns. Liabilities are what the company owes. And shareholders' equity is the difference, the net worth of the company. You're looking for a business with a strong balance sheet. Does it have a healthy amount of cash? Is the amount of debt low and manageable relative to its earnings? You can find these financial statements for free on websites like Yahoo Finance. Your first mission as a business analyst is to choose a large, well-known company and look at its income statement and balance sheet for the last 5 years. Case File 11. The margin of safety, the unbreakable rule for buying great companies at a fair price. You have now identified a wonderful business. It is a business you understand. It has a durable competitive moat. It is run by honest and able managers. And its financial statements show a long track record of consistent, growing profitability with a strong balance sheet. You have found a diamond. The amateur investor, at this point, makes a final, critical, and often fatal error. They fall in love with the business, and they rush to buy the stock at any price. The architect of wealth knows a profound truth articulated by Warren Buffett. A wonderful business can be a terrible investment if you pay too much for it. The final and most important step in the value investing process is to have the discipline to buy that wonderful business only when it is on sale. This is the principle of the margin of safety. The margin of safety is the cornerstone of the entire value investing philosophy. It is your ultimate protection against the errors and uncertainties of the future. Step 1. Calculate the intrinsic value. This is the sticker price. The intrinsic value is your best, conservative estimate of what the entire business is truly worth. A simple way for a beginner to estimate value is to use the price-to-earnings, or P/E ratio. The P/E ratio tells you how many dollars you are paying for every $1 of the company's annual profit. You can look at a company's historical PE ratio to find its average valuation. Step 2. Demand a discount. This is the margin of safety. You will never, ever pay the full intrinsic value for a business. You will always demand a significant discount. This discount is your protection in case your estimate is wrong. A classic value investor will often look for a discount of 30 to 50%. So, if you believe the fair value is a PE of 15, you will only become a buyer when Mr. Market offers it to you at a PE of 10 or less. Step 3. Wait patiently. A wonderful business is very rarely on sale. You will create a watch list of the 10 to 15 wonderful businesses you have identified. You will calculate your buy price, and then you will wait. This discipline is the single greatest trait that separates the successful value investor from the rest of the pack. Case File 12. The Circle of Competence. Why staying boring is the secret to getting rich. You're now a fully equipped value investor. You have the mindset of a business owner and a powerful checklist for identifying a great business. But as you look out at the vast universe of thousands of companies, you will be faced with a constant and dangerous temptation: the fear of missing out, or FOMO. You will hear a story about a hot new technology stock in a field you don't understand, like biotechnology. You will see its stock price doubling, and you will feel a powerful, greedy urge to jump on board. You will be tempted to invest in a business that you do not and cannot truly understand. This is the single greatest trap for an active investor. The amateur, driven by greed, consistently ventures outside of their area of expertise. They are gambling, not investing. The architect of wealth knows that the secret to long-term success is not about having a massive intellect. It is about having the intellectual humility to clearly and honestly define the boundaries of your own knowledge, and then to have the discipline to never, ever step outside of those boundaries. This is the concept of this circle of competence. This concept is another cornerstone of the Warren Buffett philosophy. Step 1. Define your circle. Take out a piece of paper and draw a circle. Inside the circle, write down the industries, products, and business models that you, through your own professional experience or deep personal interest, understand with a high degree of expertise. Be brutally honest. For most people, this will be a very small circle. Step 2. Live inside your circle. The businesses that you will consider for your investment portfolio must come only from inside this circle. It is only within your circle of competence that you have a real, sustainable competitive advantage. Step 3. The size of the circle does not matter. As Warren Buffett said, what's important is not how big the circle is. What's important is knowing the perimeter. You only need to find a handful of wonderful businesses within your small circle to build a lifetime of wealth. Step 4. Everything outside the circle is too hard. When you are presented with an exciting opportunity that is outside your circle, you will not feel FOMO. You will simply calmly place it in your mental too hard pile and move on. Part 4. The Financial Freedom Engine. Case File 13. The Tax Advantage Fortress. A simple guide to your 401k and Roth IRA. You now have the complete blueprint for a powerful, set-it-and-forget-it investment strategy. The final piece of the architectural puzzle is not what you invest in, but where you invest. The single biggest cost that will eat away at your long-term returns is taxes. The amateur investor often ignores this. They simply invest all of their money in a standard, taxable brokerage account. The architect of wealth knows that the government provides a set of incredibly powerful, special-purpose investment accounts that are designed to act as a tax fortress, shielding your investments from the drag of taxes and dramatically accelerating your journey to financial freedom. These are your retirement accounts. Your two primary weapons are the 401k and the Roth IRA. Weapon 1. The 401k. This is an employer-sponsored retirement savings plan. Its superpower is the employer match. This is the single greatest free money deal in the entire financial universe. Many employers will match a certain percentage of your contributions. The unbreakable law is that you must, at a bare minimum, contribute enough to your 401k to get the full employer match. To do anything less is a catastrophic financial error. Weapon 2. The Roth IRA. This is an individual retirement account that you open yourself. Its superpower is tax-free growth. You contribute with after-tax money, and then every single dollar of growth and every single dollar you withdraw in retirement is completely 100% tax-free. It is a legal tax haven. The government limits how much you can contribute each year. This is the Waterfall Investment Priority Protocol. Step 1. The 401k match. Your first priority is to contribute enough to your 401k to get the full match. Step 2. The Roth IRA. After you have secured the match, your next dollar should go to maxing out your Roth IRA. Step 3. Back to the 401k. If you have maxed out your Roth IRA and still have more to invest, you will now go back and contribute more to your 401k. Step 4. The taxable brokerage account. Only after you have maxed out all your available tax-advantaged accounts will you then begin to invest in your standard taxable brokerage account. Case File 14. The 4% Rule Blueprint. The simple math to know exactly when you can retire. You have your system. Your automated, low-cost, and tax-advantaged investment machine is now diligently working for you. But this raises the final and most exciting question. What is the finish line? How much money do you actually need to accumulate to achieve true, sustainable, and permanent financial independence? The amateur is operating with a vague, undefined goal. They have a fuzzy number in their head. The architect does not deal in fuzzy numbers. They require a clear, data-driven target. The most powerful blueprint for defining this target is the 4% rule of thumb, also known as the safe withdrawal rate. The 4% rule is the result of a famous academic study. It is a simple, powerful, and conservative rule of thumb for determining how much you can safely withdraw from your investment portfolio each year in retirement without running out of money. The rule states, you can safely withdraw 4% of your portfolio's initial value in your first year of retirement, and then adjust that amount for inflation each subsequent year, with a very high probability that your money will last for at least 30 years. The 4% rule allows us to perform a simple piece of reverse engineering to calculate our financial independence number. Step 1. Calculate your annual expenses. First, you must know how much money you actually need to live on per year. Let's use an example of $96,000 per year. Step 2. The multiply by 25 rule. To calculate your financial independence, or FI, number, you will simply take your required annual expenses and multiply that number by 25. So, $96,000 per year times 25 equals an FI number of $2,400,000. Multiplying by 25 is just the mathematical inverse of the 4% rule. If you have $2.4 million and you withdraw 4% of it, you get $96,000. You now have your two most important numbers, your annual savings goal and your FI number. You can now use a simple online compound interest calculator to architect your timeline. You have transformed the vague dream of retirement into a simple, concrete, and achievable engineering project. Case File 15. The Long Game. A playbook for staying the course, ignoring the noise, and building generational wealth. You have reached the end of this roadmap. You are now in possession of the complete, end-to-end architectural blueprint for your financial freedom. You have the mindset of a business owner. You have a simple, powerful, and automated three-fund portfolio that is diligently compounding for you. You have a clear, data-driven FI number that serves as your North Star. The machine is built. It is running. It is perfect. And now, you face the final, and perhaps the greatest, challenge of your entire investment journey: doing nothing. Over the next 10, 20, and 30 years, the world will be a relentless, chaotic, and deafening storm of noise, all of which will be designed to knock you off this simple, proven path. There will be terrifying market crashes. Your colleague will tell you about a hot, new stock. A new, trendy investment product will be invented. The amateur investor, driven by fear and greed, will be thrown about by this storm. They will sell at the bottom. They will abandon their boring plan to chase a hot trend. They will tinker with their machine until it breaks. The architect's final and most profound job is to become the stoic, unwavering guardian of the system. Your single, most important task from this day forward is to have the discipline and the courage to stay the course. This is the Stay the Course blueprint. 1. The automate and ignore mandate. Your automated investment plan is your single greatest defense against your own worst instincts. You must let it run, untouched. You will not check your portfolio balance. You will not read the daily financial news. 2. The annual rebalance. This is your one and only action. Once a year, and only once a year, you will log into your portfolio. Over time, your asset allocation will drift. Your one job is to rebalance. You will sell a small portion of your winner and use the proceeds to buy more of your loser to get your portfolio back to your original target allocation. This is a simple, disciplined way to automatically sell high and buy low. 3. The read history antidote. If you ever feel the pull of fear or greed, you will not read today's news. You will read financial history. You will see that there has always been a terrifying crisis, and you will see that through all of it, the broad arc of human ingenuity and economic progress has been relentlessly upward. Conclusion: you are the architect of your freedom. You began this roadmap with a myth, the myth of the Wall Street genius, the belief that the world of investing was a complex, rigged game that was not meant for you. You saw a world of fear, of risk, and of intimidating jargon, and you were a spectator, standing on the sidelines of your own financial future. That myth has now been fully deconstructed and replaced with a powerful, engineered reality. You now know that successful investing is not about gambling. It is about owning. It is not an act of genius. It is an act of discipline. You are not a speculator. You are a business owner, an architect of wealth. You have deconstructed the unbreakable mathematical law of compounding, the single most powerful force for wealth creation on the planet. You have filled your toolkit with a simple, powerful, and devastatingly effective set-it-and-forget-it investment strategy built on low-cost, globally diversified index funds. Most importantly, you have moved beyond theory. You have a clear, data-driven blueprint for calculating your financial independence number, turning the vague dream of retirement into a concrete, achievable engineering project. You have the mental models and the stoic mindset required to navigate the inevitable storms of the market with calm and confidence. You do not just have knowledge. You have a complete, end-to-end, automated system for building a lifetime of wealth. The path from here is one of patience and discipline. It is the work of executing your plan, of trusting the system you have built, and of having the long-term courage to ignore the short-term noise. You're no longer a passive passenger in your financial life. You're the pilot. You possess the blueprint for a machine that will work for you day and night for decades to come, quietly and relentlessly architecting your financial freedom. You are the architect of your freedom. Now go build. Did this roadmap help you? Your journey is just beginning, but your feedback is crucial. If this book provided you with real-world value, the single best way to support this mission is to leave an honest review on Amazon. More by Gardinski. Your roadmap continues. You have a roadmap to building $1 million portfolio. Now, build the complete financial system that will fund it and protect it. Book recommendations include From Zero to Investor, Low-Cost Portfolio, and From Zero to Financially Free.